this is the FG coffee break. That's what we're gonna call it? FG coffee. Yeah. So we got our coffees. So welcome everybody. Basically, what we're gonna do here is me and Chris every Friday. We're gonna take a few minutes, talk about the market, any relevant news, also chat about things that happen throughout the week. This is kind of just an opportunity for people to see what we do on a weekly basis, get their news on the market, and honestly, just kind of get a feel of what we do and how we work together at FG. So,
Exactly.
what do you think about that? Does that sound like it's what we want to do?
Exactly what we want to do. And we want to keep it real. We want to keep this raw, uncut. We're just connecting with you guys, the clients, and our listeners as well. So we just want to have fun with this. Gives us a chance to catch up, wrap up the week, and talk about everything: business, finances, life. And we'll see where these conversations go. These are unplanned, by the way, unscripted. So we just see where this takes us.
Yeah, and I mean, this is pretty much what we do every Friday. Friday, we used to call it level 10 meetings. Now we just kind of got the habit of connecting on Fridays, talking about the week, all of that. So I think it's pretty much what we already did. Now we're making it a little bit more public. And I mean, with time, I'm sure we'll see if people want us to talk about anything in particular. Fine, but I think for now it's just it's a good exercise to kind of have people know what goes on behind the scenes at FG. So, well, Chris, on my end, I'll just start with what I usually ask you on Fridays. What's going on with the market? Is there anything? I mean, yesterday we saw a nice jump. So, what was that about? Is that caused by anything in particular, or?
So the market did go up significantly yesterday. Look, we've had a pretty big correction since July. The market, when it reached its bottom, it's been down about 10%. It was the worst correction we've seen this year. But what people fail to realize, these 10% corrections happen all the time. On average, we get one every 1.6 years for the past 100 years. So it's normal. One of my biggest, not worries, but something that I see often with clients, it's that short-term vision. We'll have a new client, is let's say they've been with us for a year and say, man, my investments are down, or it's been down, or other advisors will see this problem as well. I look, it's going to be long term. Look at a 5 year horizon, a 10-year horizon. That's why we invest. Like you told one of your clients this week, they're buying
I was gonna say.
companies at a discount all the time. There's been periods where the S&P 500 has been flat for 10 years. When you talk to most people, it's one of the best invest. I mean, you're buying the 500 best companies in the United States. So you're bound to make money long term, but it's that shorter term vision that's sometimes going to put a break to our habits, to our investments or whatnot. So look, you stay invested. That's what you got to do. You know your profile, you know your horizon, and you just keep at it. And if you miss those big days in the long term, it makes a big difference on your potential long-term returns. So forget the noise. There's going to always be volatility, Zach, as you know. So we had a good day. We'll have bad days. We'll have great days. In the long term, what I know is the market goes like this. So I just try to drown
Yeah.
out the noise on the short term. But one thing I wanted to talk to you about, and actually I read it this morning. As you know, I like to start my day seeing what's going on, reading in the markets. And one thing that jumped out to me between 2024 and 2026, so in the next couple of years,
Okay.
there's going to be over 900 billion, not million, $1 billion worth of mortgages that are due to be renewed. That's 60%
Okay.
of all outstanding mortgages. And I think it's something we should talk about, Zach. I mean, it's pretty relevant. We talk to our clients. What do they say? Look, everything's more expensive. Some people don't even have enough liquidity right now to be saving money. So imagine that in the next 2 years, 60% of those people come to renew. And next thing you know, the price goes up by 30%, 50%. Where are they going to get that money from? So that is one of my concerns here on the Canadian side. So what do you think about that? What do you if you have any thoughts to share on that?
I mean, I think it just goes to show that we've been hearing a lot about the interest rates rising, rising, but maybe not everybody has felt it because if you're on a fixed rate, you haven't really felt the effects of the interest rates rising. For me personally, before I sold my condo in Montreal, I was on a variable rate. Thank God I was on a fixed payment, so I was able to pay my mortgage every month. However, the amount of interest I was paying or I owed every month wasn't even enough with the payments I was doing. So basically, I would pay my mortgage, but my mortgage would actually go up because I wasn't even paying all the interest I owed, but at
Right.
least my payments stayed the same. So, contrarily to other people where their payments, I had some clients, I think their payments went up $600 in the past year, their
Yep.
mortgage payments. And now their only focus is not even saving anymore. It's just, Zach, we got to keep the house. So we just prioritize an emergency fund to make sure that if anything else happens, they're good. But now, with, like you said, these mortgages coming due, these renewals coming due, well, now even the people who had a fixed rate and who weren't really affected by these high interest rates, now they're gonna see, they're gonna hit that wall. They're gonna see the effects of the high interest rates. And if you're saying that you said 60% of mortgages are coming
Yeah.
in the next couple of years,
Yeah. 6-0 in the next by 2026. It's huge.
so that's massive. So that's where we're going to start seeing the real effects of interest rates. And we were talking about it amongst each other during COVID, but we didn't see the effects during COVID. Government was giving out free money. Then we started seeing effect number one, inflation started going crazy. Effect
Yeah.
number two, now we're high interest rates to counter the inflation. Well, now we're about to see those house payments becoming maybe unrealistic. Uh, I don't know. I'd be curious to talk to your realtor. Is that something where they're going to see a flip where now people are going to start selling a lot more of their houses because they just can't manage it anymore? Maybe people who are close to going into a retirement home. Is that the extra nudge they needed to finally sell their house and go into a retirement home? I actually saw an article this week where there's a couple who did like 50 something consecutive cruises because they realized that
It's
was
cheap.
cheaper than going into a retirement home. Yeah.
That sounds pretty nice. And
But
on that topic too, I was reading there another stat, Zach, that surprised me. Right now in the US, I'd be curious to see what it is in Canada. But right now, buying a home versus renting costs 52% more to be a homeowner than a renter. 5-2,
wow.
that's huge. The last peak we saw was in 2006 before the financial crisis on the housing bubble, which was at 33%. So that
Wow.
when I read that one, it was rather surprising, a little alarming, because as you know, buying well, home ownership is one of the best ways to build equity, to grow wealth. Um, but it was just, and talking to young people, some of them say, "Well, I don't know when I'll be able to buy. I don't know when I'll be able to
Yeah.
rent. The rates are so high; it's just so expensive." Some of them have locked into rental agreements where they're paying nothing. So if you have a beautiful place downtown Montreal, downtown, well, Toronto's probably out of the question, but let's say they've been there for a long time and they're paying $1,000 a month, doing the switch and buying a property, and now they're paying a mortgage of 3,000, 4,000, or there's property taxes on top of that. It can be quite alarming. At the end of the day, I'm
But do
still
you,
on. No, go ahead, go ahead.
I was gonna say, do you think that it's just that it hasn't caught up to the renters yet? Because even if you're renting, there is a mortgage somewhere.
Yeah,
So let's say if 60% of these mortgages are about to renew in the next few years, well, that means the person renting out their apartment complex or whatever, their mortgage is about to renew. So there's going to be that increase. And we all know they're not going to take the burden themselves. They're going to try to push it on their renters. So is it just something that it hasn't hit the renters market yet?
I think what protects the renters is there are, well, especially in Quebec, there are limits
Mm.
to the amount you can
Yeah.
increase that payment. So on their side, it's like, man, I'm just gonna stay here. Okay, I'll take my 2, 3, 4% increase. I'm okay with that. I'll live with that, even though I know the mortgage payments have been up 30 some percent, 40%. So
Mm.
they've got maybe the upper end of the stick, if I can say, for that side. But at the same time, if they want to buy, they've got that perfect storm of headwinds of, and then everything costs so much more. There's the higher inflation, the rates are higher, even the properties are selling for a lot more. So it's yeah, it's tough to see, but we've got plans. At least we got the first home buyer savings plan there account
Yeah.
in place. So we've been putting those in place for our clients, and I'm still in that philosophy. Some people won't agree, but if you have the money, you found the property you want, you can pay for it, buy it, go build that
Well,
equity.
the
So that's
the
my
the way I see it is, and that's like I had family that did a lot of real estate, so that's something where I knew as young as possible I want to buy my first property.
yeah,
And I'm wondering now if this still applies because of all the high interest rates. And now you said 52% more that it'll cost to buy than to.
than to
So the
average.
way I see it is, let's say, and these aren't real numbers. I'm not a mortgage broker. I'm just going to throw them out there as examples. But let's say you're paying your mortgage. It's like $1,000. Again, round number. I don't even know if that's realistic anymore. But $1,000 for your mortgage. But out of that $1,000, there's 300 that goes towards paying your capital.
Right,
700 that's interest. Well, the way I see it is that you're paying 700 but you're setting $300 aside. I didn't see it that way as much when I bought my first condo, but after selling, then I realized that okay, well, when I sell, I go get all that money I put down on my mortgage. Now I get it back. Now I can benefit from that, and then which helped me buy my next property. So that's one thing that is it still worth it? Because I used to tell people you can rent or you could pay off a mortgage and then put money that even though you're paying off your mortgage, it's money that's going to be in your pockets eventually. So I kind of saw it as a savings vehicle in a way, but is now just the difference between buying and renting too big that it's not even a factor. You're better off just setting money aside and investing it yourself.
it's tough to say. I mean, market environments can change. I like building that equity because it's just another diversifier. So I'm
Mm.
still personally, if you have the money, you can do it. Buy the property, build that equity, even though you're building less equity quick because, like as you said, you're paying a lot more towards the well in interest rather than the capital. But I think you still want to have that brick and mortar. So yeah, that's one of those things. And look, luckily, as we have good real estate agents that we work with, we
Mm.
have some of the best mortgage brokers that we deal with. So if you guys have questions on that, reach out to us. We've got the teams in place to get those your goal put together, and we have all the financial strategies to make sure we can accelerate it. So those are the things. We got the protection from A to Z. So yeah, I just wanted to touch base on that because I think it's important. And most people, I mean, it's like the American dream. Sorry, I have my dog that wants to join in, but that same
Oh no,
American
now my dog is looking at me like, hey, what's going on over there?
too. So it's that dream, you want to be able to own property, and the same thing in Canada. So that's one of those little things.
Yeah, and you touched on a conversation I had with a client earlier this week because we've been investing for a year, and he wasn't necessarily too excited with the performance of his portfolio. I think it was up like 1.5% or something. And I told him, I said, look, I said, right now, first of all, these investments, this was money you're not supposed to touch for the next 10 years. He's in accumulation. He's not trying to save for property right now. He's really looking long term. So, first of all, when we invest like that, looking at 1 year is very hard to judge an investment over 1 year. Usually we're looking at least 5 years, which is, I think that's what you told me, that you always look at least 5 years. But what I told him is that right now, people our age, I'm about to be 29. You're 29 as well. This client is in his early 30s, I believe. So very long-term vision. I told him people in our situation right now, it's time to put money aside. Throw your money in the market as much as you can afford. Because why? You're buying everything at a discount. So let's say you gas was at 150 a liter. Well, now it's at $1 a liter. So that same 20, $40 you set aside every week, well, you're buying way more liters with that same $40. So that's why we implement that weekly or bi-weekly investments in the market. And people our age, we're really encouraging them buy into the market because right now you're buying everything at a discount. Where you're at a big disadvantage right now, if it's for our clients that are in retirement, that are in the market. Personally, in the last few years, I have very few. Most of them just want to be in guaranteed. Obviously, if they're at a deficit for their retirement, then we just have to take more risk because they won't have enough money. But most of them, if we're good for retirement, we're putting in the guaranteed, benefiting from the high interest rates. But those who are really affected by a bad market right now are those who need the money right now and who are still in the market. Those who will benefit the most, in my opinion, and I'm curious to hear what you have to think, Chris, after that. But I feel like those who are really benefiting the most in the long term are those who are investing in the market right now, regularly, every week or every 2 weeks, but that don't need to use the money right now. They're in the accumulation phase. So it might be a blessing in disguise for a lot of people right now. What do you think?
You brought up some great points, Zach. For sure. Look, the retired clients last year was one of the worst years. Well, the bond market, 40 years, we haven't seen such an, well, it was the worst year, down 12%. So the more secure part of the portfolio, the one that's supposed to be your, to protect your capital and your nest egg was down 12%. They haven't seen that. And especially since so wait, it's just been an up market. So it's been gains, 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 even on the secure part. Now, bang, down 12%. And most of them
Can
since,
you unwrap that a bit, the bonds market? Because I know that some
yeah.
people hear that, they've heard the term, but what does that even mean? And why is it people who have a more secure portfolio that were affected by that specifically?
So we have kind of the main asset classes are stocks and bonds. Stock is where you buy ownership in a company, such as Tim Warren. You become a part owner as their earnings grow. You appreciate with that, and you can collect the dividend as well. Bonds, on the other side, it's more secure because you'll lend to these same institutions, such as Timmy's. You'll give them some money, and in return, they'll give you a guaranteed rate of return, such as a 2, 3, 4, 5, 6% yield for borrowing that money. What happened was last year, there's an inverse relationship with rates and the value of the bonds. So when rates were near zero and they shot up to 5%, the value of all these bonds went down significantly. Why? You can go on the market now and get a 5, 6, 7% bond, while the ones you were owning before were paying 2, 3%. Huge, huge impact on valuation. There's a little blessing in disguise, though. Now they're going to be paid a lot more for holding these investments. I find the bond market rather pretty attractive, looking at shorter term bonds with pretty significant yields. The equity market, as you said, there's a lot of potential for long term clients. If they're starting out in more volatile years, they can get stuff at a discount. One of the biggest mistakes I see people making, Zach, and I was looking at my returns today. So a lot of my clients, I like to implement infrastructure. Infrastructure are real assets, bridges, highways, airports, utility companies. I like to own them. They offer significant dividend. It's a diversifier and whatnot. It was one of the worst performing assets this year because of the rising rates and all that. Yet last week, up 5% was one of my best sectors. So people might have said, oh, well, look, I want to sell out of infrastructure. It's not doing well. No, things that do bad mostly will come around the next years and be one of the top performers. That's why we build our portfolios, Zach, with different styles. We have growth, we have momentum, we have value. We want to be well diversified for our clients. And I'd be willing to throw more money at something that's not doing too well, knowing that there'll be a switch in style and a switch and go. So be diversified, keep investing, go for the long run. That's what we got to do, and just keep doing it, and not let our emotions go in on that.
So if someone, let's say, doesn't work with us, they have their own advisor, but they're listening right now, should everybody be in infrastructure right now, or is it more for those who want a conservative portfolio? Who should be asking their advisor right now to look into infrastructure?
Good question. So for me, for my clients that I put infrastructure in, it's my clients are a bit older. I want to have a nice diversifier. Myself, I do not own any infrastructure right now. I'm 99% in stocks and within my different styles. But for my clients that are approaching retirement, want to smooth out the ride while having some, an asset class with nice returns, I'll gladly put infrastructure. I look to put between 10 and 15%. And it does the job. It's done very well for my clients in the past 5, 10 years that we've been holding infrastructure.
So one thing you mentioned is that right now you're mostly in equities. You also mentioned that bonds are going to be doing very well in the next few years. Is there any value for, now we're talking someone who is not trying to touch this money? They're really investing long term. Now that bonds are going to have such a high value because of the high interest rates, is there any value in going to get bonds, or if you're thinking long term, you're still going to be winning going with stocks?
Long term.
Because I'm in some bonds, so that's why I'm asking, because I do like the fact I don't know when's the next time bonds are going to be this valuable. So that's why I'm going to get some bonds right now, but mainly 85% I'm in stocks.
Zach, it's the first time in my life that I own some bonds. Just to give you an
Okay.
idea, okay? Um, I'm not buying them on a systematic basis. Why? It's stocks. You own stock, you own companies for that significant long-term growth. However, I do have a part of my portfolio that I had cash on hand. I wanted to put, I bought some bonds. They're going to do very well. I'm not worried about it. I'm with one of the best bond managers in Canada. I'm expecting maybe a 7% return yield on that, plus the appreciation. So, so I think, sorry about that. So I think that's something that's really important to have in the portfolio.
Awesome. Well, listen, I think for a first episode we did fairly well, you know. But listen, we're gonna be doing more of these. Obviously, this will be posted probably at the end of the day. If people enjoyed it, obviously, please like, subscribe. I don't even know where this is going to be posted. YouTube, Spotify. I'm not sure yet, but let us know what you want us to talk about. Any questions? That's why we're doing it. Basically, is just kind of another form to educate. That's really one of our priorities. On top of helping our clients, obviously, we can't take everybody as a client, so this is kind of our way of giving back to those who we don't necessarily have as clients right now. It's just putting information out there. And what will help us is actually knowing exactly what people are curious about. Obviously, we work with individuals for their investments, insurance protections, financial plans, retirement plans, and we work with business owners, whether it's exit planning, you want to sell your business in the next few years, you want to make sure you cash in that equity, and then planning life after owning a business. Those are all things we do, all topics we're going to talk about. Chris, before we wrap it up, any last words on to wrap up the week?
No, just look, if you're invested in the markets, stay invested, believe in the capital markets, you'll do very well, and let that money compound for the long term. It's one of the best ways to grow significant wealth. And thank you guys for this little conversation. I'm having fun. Zach's having fun. We like this, and we just want to bring as much value as possible to our listeners.
All right. Well, have a great weekend. Take care, guys.
Take care.